Welcome back to Algobot, where we break down automated trading strategies one careful piece at a time. I'm your guide here at Algobot, and in today's lesson we're studying a MetaTrader 5 expert advisor called Pivot Engulfing Fade Hedge. This is a pure price action approach. It maps out classic floor trader pivot levels, watches for engulfing candles forming at those levels, and fades short-term moves that have stretched a little too far. By the end of this video, you'll understand how it builds its pivots, how it reads the candles, where it places its stop and its target, and how its optional hedge leg is designed to work. Remember, everything here is educational information only. Let's get started. Let's start with the big picture. Pivot Engulfing Fade Hedge is described in its own source code as a pure price action reversal scalper. That phrase tells you almost everything. It is a reversal strategy, meaning it looks to enter against a short-term move rather than chase it. It is a scalper, meaning it works on the smaller, faster swings of the chart. And it is pure price action, meaning it uses no moving averages, no oscillators, and no indicators of any kind. Every decision comes directly from the raw open, high, low, and close of the candles. So what actually drives it? Two things working together. First, floor trader pivot levels. The strategy looks back over a window of recent completed bars, finds the highest high and the lowest low, and combines them with the most recent close to calculate a central pivot point, a resistance level called R1, and a support level called S1. These are simple arithmetic levels that many traders have watched for decades. Second, the engulfing candle pattern. This is a two-candle reversal pattern where the current candle's body completely engulfs the previous candle's body in the opposite direction. The strategy waits for these two ideas to line up. When price rallies up into the R1 resistance band and then prints a bearish engulfing candle, the strategy fades that rally by selling. When price dips down into the S1 support band and then prints a bullish engulfing candle, it fades that dip by buying. Every entry carries a fixed stop placed beyond the engulfing candle's extreme and a take-profit set by a reward-to-risk ratio. There is also a hedge component. If price keeps running against an open trade past a configurable fraction of the stop distance, the strategy opens an opposite hedge leg to help cap the drawdown and follow the continuation. In terms of who it suits, this is an educational example aimed at traders who want to study how pivot levels and reversal candle patterns can be combined inside an automated system. As always, trading involves risk, and losses are a normal part of any approach. Now let's walk through the exact logic step by step. The expert advisor only acts on completed bars, so it uses a new bar check and evaluates a fresh entry once each candle finishes. On every new bar, it rebuilds its pivots. Using the PivotLookback parameter, which defaults to 20 bars, it scans those recent completed candles and records the highest high and the lowest low. The difference between them is the recent range. It then takes the most recent completed close and calculates the central pivot point as the average of the high, the low, and that close. From there, the resistance level R1 is 2 times the pivot point minus the low, and the support level S1 is 2 times the pivot point minus the high. Next, it defines two cushions. The proximity band is the ProximityPct parameter, which defaults to 20%, multiplied by the recent range. This band is how close to a pivot price needs to be to count as being at that level. The buffer is 10% of the range, and it pads the stop just beyond the signal candle's extreme. Then it reads the two newest completed candles for an engulfing pattern. For a long, the strategy needs a bullish engulfing candle whose low has reached into the S1 support band. When that condition is met, it enters a buy at the ask. The stop goes below the signal candle's low, minus the buffer. The distance from entry to stop is the risk, and the take profit is placed above the entry at the reward-risk ratio, which defaults to 1.5, multiplied by that risk. For a short, it mirrors everything. It needs a bearish engulfing candle whose high has pushed into the R1 resistance band. It then sells at the bid, places the stop above the signal candle's high plus the buffer, and sets the take profit below the entry by the same reward-to-risk multiple. Only one trade cycle runs at a time, so it looks for a new entry only while it is completely flat. Finally, the hedge. On every tick, if a primary trade is open and no hedge exists yet, the strategy measures how far price has moved against it. If that adverse move reaches the HedgeTriggerPct, which defaults to 60% of the stop distance. It opens an opposite leg sized at the base lot times the hedge multiplier, defaulting to 1.5. That hedge has its own stop and target, and once the position is flat again, the cycle resets. Let's read through the MQL5 on screen, just as you would inside MetaTrader. At the top are the input parameters. PivotLookback sets how many bars build the pivots. ProximityPct controls the band around each level. Reward-risk ratio scales the take-profit relative to the risk. HedgeTriggerPct and hedge multiplier govern the hedge leg, and lots is the base trade size. These are the dials you can adjust in the strategy tester. Now look at the buy block. The condition reads, if bull engulf is true, and the signal candle's low is at or below S1 plus the band. In plain English, the most recent two candles formed a bullish engulfing pattern, and that candle dipped into the S1 support band. When both are true, the entry price is taken from the ask. The stop loss is set just below the signal candle's low, minus the buffer. The code measures risk as entry minus stop, checks that it is positive, and then sets the take profit above the entry by the reward to risk multiple. It calls open leg with the buy order type. The sell block is the mirror image. If bear engulf is true and the signal candle's high reached are 1 minus the band, the entry comes from the bid. The stop sits above the signal candle's high plus the buffer. Risk is stop minus entry, and the take profit is placed below the entry by the same multiple. Finally, the open leg helper at the bottom is where the order is actually sent. If the type is a buy, it calls trade.buy with the volume, stop, and target. Otherwise, it calls trade.sell. Both sides share that one clean routine. Let's bring this to life on the chart. You can see 3 dashed horizontal lines. The middle one is the pivot point. The lower green line is the S1 support pivot, and the upper red line is the R1 resistance pivot. These are the levels the strategy builds from the recent range, and price is going to interact with both of them. Look at the first few candles. Price is drifting down, away from the central pivot point, and heading toward the S1 support pivot. The second candle is a solid bearish candle that pushes its low right down into the S1 support band. On its own, that is just a falling market. The strategy does not act yet. It is waiting for confirmation. That confirmation arrives on the next candle. It opens near the bottom of the prior candle and then closes strongly higher, and its body completely engulfs the previous candle's body. This is a bullish engulfing pattern, and crucially, its low is still inside the S1 support band. Both conditions are now satisfied. A bullish engulfing candle, fading a dip into S1. Once that candle completes, the strategy steps in. On the next bar, you see the buy entry marker. The stop is tucked just below the engulfing candle's low, with a small buffer beneath it, and the take profit target is set above, at the reward to risk multiple of 1.5. Now follow the move. Price lifts off the support pivot candle by candle, climbing back up through the pivot point. Each green candle carries it higher, and by the candle marked take profit, price has reached the long target. That first trade is complete. Notice the logic. The strategy did not buy because price was falling. It bought because a stretched move into support was rejected by a reversal candle, and it rode the bounce to a measured target. Now watch the second half of the chart, the short side. After the long closes, price keeps pushing higher. A strong bullish candle drives all the way up into the R1 resistance band. Again, that move alone is not a signal. The strategy waits. On the very next candle, price opens above the prior close and then sells off hard, closing below the prior open. Its body engulfs the previous candle in the bearish direction, and its high is sitting up inside the R1 resistance band. That is a bearish engulfing fading a rally into R1, which is the exact mirror of the long setup. So on the following bar, you see the sell entry marker. The stop is placed just above the engulfing candle's high, with the buffer added on top, and the take profit is projected downward at the same 1.5 reward to risk multiple. From there, price rolls over. It slides back down through the pivot point, candle after candle, until it reaches the short take profit marker near the lower part of the chart. The second trade is complete. One last idea to tie it together. Suppose, after either entry, price had instead continued straight against the position. Once the adverse move reached 60% of the stop distance, the strategy would have opened an opposite hedge leg, sized at 1.5 times the base lot. to help cap the drawdown and follow the continuation. That hedge is the strategy's answer to a setup that does not work out. Everything you have seen here is an illustration for learning purposes, and real markets will not always behave this cleanly. So let's recap what we covered today. Pivot Engulfing Fade Hedge is a pure price action reversal strategy. It builds floor trader pivots from recent bars, then fades rallies into R1 using bearish engulfing candles and fades dips into S1 using bullish engulfing candles. Each trade carries a structure-based stop beyond the candle's extreme and a reward-to-risk target, with an optional hedge leg if price runs against the position. We walked through the parameters, the entry and exit code for both sides, and a candle-by-candle example of a long and a short. Everything in this video is for educational purposes only and is not financial advice, a recommendation, or a solicitation. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like us to break down next. Learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.